Hi there, I'm Champion Trader Kevin Davey, and here's another one of your algo trading questions answered. So let's get started. Okay, so today's question, this person submitted a backtest to me and said, I created the following backtest. What do you think of it? Before I show you what they gave me, the first thing you should realize is most backtests are bogus. You might say, wow, what do you mean by that? Well, there's a lot of ways to incorrectly build a backtest. And at the end of the day, when you're finally done, you might not know the things that went into it. So, for example, you could have overfit and gotten a great equity curve. So maybe it's real, maybe it's fake. You don't know. You could have forgotten slippage and commission. You could have taken advantage of limit order fills, all sorts of things that you could have done. And that's what you got to watch out for if you see somebody else's equity curve. If you don't know exactly how it was built, you've got to really be worried about it, and you got to suspect that it could be fake. Now, there's a lot of honest people out there who will give you an honest equity curve, but there's also a lot of fakers out there. And they'll show you an equity curve and say, oh, hey, you got to admire this, when it might not be that good because of how they built it. So keep that in mind. But let's assume for this discussion that this person did things correctly. And let's take a look at their equity curve and their performance statistics. Okay, so if I look at the chart on the left, this looks pretty good. Hey, it's got higher highs, it's upwards to the right. It's got some pretty decent drawdowns. It looks like it's probably taking some big losses. It's probably got like a big stop loss, and every once in a while it gets nailed by that. And you can see those pretty severe drops, but it does recover. So it looks like maybe there's a lot of little wins and a lot of big losses. If we look over on the right and look at the performance report, we see the average winning trade's about $45 and the average losing trade is $300 some dollars. So that kind of fits what we're seeing with the equity curve. Now, most of the numbers here, hey, they look pretty decent. You've got a decent profit factor. You've got a lot of trades, 90%, over 90% profitable trades. That's really good. But for this type of trading, it was kind of expected. You're getting little profits with big losses. Now, some of the things that I don't like about it, look towards the bottom. It says total slippage, 0. So this person's including commissions, but nothing for slippage. And if you go up about halfway, you see average trade net profit of $14. I'll tell you what, RTY slippage is going to take that profit completely away. So just seeing that, I know this strategy is not going to be profitable. Another red flag, if that wasn't enough, is look at the top and look at the test period. It's from September 25th to Christmas Eve. So 3 months. 3 months is not enough to do any kind of legitimate back test, because the market within a 3-month period will definitely be different 3 months from now, 6 months from now. You can't really rely on such a short test. That makes me think, hey, this isn't as good as it looks. It's probably something that was over-optimized, and it came out with this great equity curve just on this 3-month period. But I bet if you looked at other periods of time, it would fall apart. Especially then you add in slippage, just gets a lot worse. So this is what I would consider a no-go back test. I would just chuck it at this point. That being said, how do you build good back tests? Well, there's really 3 good steps, 3 solid steps that you got to take. First is you want to build it yourself. Remember I mentioned You don't want to rely on somebody else's equity curve and just trust they built it the right way. You want to build it yourself. You want to know what went into it. That is one key. The second is you want to have a solid process, okay? You want to build it on a solid foundation. That's your trading process. That's how you build systems. So if you were building a house, you first build that foundation, right? And then you can build a house on top of it. What you don't do is just build a house on a weak foundation or one of sand, right? That'd be silly. But so many people do that with their trading strategies. They're building strategies with no idea what makes a good strategy and what kind of tests they should run. And just like this, their house is going to collapse. Their trading system's probably going to collapse. And then the third part, the third key to building good systems after you've built it yourself using a good process is to watch it live for a while. Don't immediately start trading it, but let it run in the real market for a while without real money and see what happens. A lot of times if you've overfit, and you've probably seen this in other videos I've done, the performance will drop off pretty quickly and pretty noticeably. So that's how you can take a back test and develop a system and make sure you know you have something that could be worth trading. If you like this video, give it a thumbs up, hit the comments, and also hit the subscribe button. Thanks for watching.